If you spend enough time scrolling through financial TikTok or Reddit's investing forums, you start to notice something. Everyone sounds like an expert. People throw around phrases like buy the dip, diamond hands, or time in the market beats timing the market, as if they're ancient wisdom passed down from Warren Buffett himself. But here's the thing. A lot of what we believe about the stock market isn't true. Some of it used to be true, back when brokers wore suits and trades happened over the phone. Some of it was never true to begin with. And yet these myths keep circulating, keeping regular investors stuck, scared, or flat out broke. I've been investing for almost a decade now, long enough to have made every mistake in the book. I've bought high, sold low, panicked during crashes, and held too long during rallies. And through it all, I realized that most people don't lose money because they're unlucky. They lose because they're following rules that were never real in the first place. So let's talk about a few of those myths, the quiet lies we tell ourselves about money, risk, and the market, and how they quietly drain our potential to grow wealth. The myth of you need a lot of money to invest. For the longest time, I believed investing was something only rich people did. I thought you needed thousands of dollars, a fancy brokerage account, and a financial advisor who spoke in graphs. That illusion shattered in 2020 when I opened a Robinhood account with $50, not because I wanted to get rich, but because I wanted to see how it worked. I bought one share of Ford for $8.90 and one share of SoFi for $12. Over the next few months, I slowly added $10 here, $20 there. By the end of the year, I had turned $50 into about $185, not through brilliance, but consistency. The truth is, you don't need wealth to start investing. Investing is how you build wealth. Thanks to fractional shares, no-fee trading, and apps that let you buy a piece of Apple or Amazon for as little as $1, anyone can start. The real barrier isn't money, it's mindset. The person who invests $10 a week consistently will outperform the one waiting for the right time to start with $1,000. Compounding doesn't care about your income. It only cares about time. The longer you wait, the less time you give your money to work for you. The myth of safe stocks. There's no such thing as a safe stock, only less dangerous ones. People love to believe that big established names like Coca-Cola, Disney, or AT&T are safe havens. They're not. They're just less volatile. But if you bought Disney in March 2021, when it was trading at $197, you've been sitting on a painful reality check. By 2024, that same stock dropped below $90, more than a 50% loss. Safety in the market is a relative illusion. Every stock carries risk because every company is vulnerable to inflation, politics, consumer behavior, or a CEO making one bad decision. Even Apple, arguably one of the most successful businesses on the planet, saw its stock dip nearly 25% in 2022. The investors who survive the market aren't the ones looking for safe stocks. They're the ones who understand risk and manage it. That means diversification, patience, and never betting more than you can afford to lose on a single idea. If you want safety, you don't find it in a ticker symbol. You build it through discipline. The myth of buy low, sell high. It sounds perfect, doesn't it? Buy when the price is down, sell when it's up. The simplest formula in finance. But anyone who's tried it knows how hard it really is. The problem isn't the logic, it's emotion. When stocks crash, fear takes over. When they soar, greed kicks in, and both emotions destroy timing. I learned that the hard way in 2021 when I bought Peloton, PTON, at $102, thinking I was getting a deal after it had dropped from $140. It'll rebound, I told myself. A year later, it was trading under $10. The truth is, buy low, sell high assumes you can predict what low and high actually are. But the market doesn't care about your definition. Prices can always go lower, and rallies can always end sooner than you expect. Smart investors don't obsess over perfect timing. They focus on time in the market. Instead of chasing dips or peaks, they invest regularly, whether prices are up or down. Because over years, consistency beats precision. If you try to outsmart the market, it will humble you. But if you respect it, it will reward you. The myth of you can beat Wall Street. Every retail investor dreams of outsmarting the big guys. It's romantic. The lone trader sitting at their laptop, taking on hedge funds and winning. And sometimes it happens. We all remember GameStop, GME, in 2021, when everyday traders took on Wall Street and sent the stock from $17 to $483 in a matter of weeks. But that story, like most myths, leaves out the ending. The same retail investors who made $10,000 overnight often lost it just as fast when the price crashed back down. The average person doesn't have the tools, data, or capital that professional traders do. Wall Street runs on algorithms, insider networks, and institutional discipline. Retail traders often run on emotions, Reddit posts, and luck. That doesn't mean you can't make money. It just means you shouldn't play their game. Beating Wall Street isn't about trading faster or riskier. It's about doing what they can't, being patient. Hedge funds chase quarterly profits. Regular investors can wait years. That's your edge. The retail investor who quietly invests $200 a month into an index fund like the S&P 500 ETF, VOO, will almost always outperform the trader glued to candlestick charts at 2 a.m. Beating Wall Street isn't about making noise. It's about surviving long enough to let compounding do the work. The myth of the market is rigged against you. This one is tricky because there's some truth to it. High-frequency trading, insider advantages, and algorithmic systems do tilt the playing field. But here's the secret. Wall Street doesn't want to admit retail investors have never had it better. You don't pay commissions anymore. You can buy fractional shares. You can invest in global markets from your phone. You can access real-time data, AI analysis, and financial education that used to cost thousands of dollars, all for free. Yes, there are scams. Yes, there's manipulation. But blaming the system is a comfortable excuse for not learning how to navigate it. The people who say the market is rigged often mean the market didn't give me what I wanted. I've seen friends give up after losing $50 on a bad trade, swearing the system is fixed. But I've also seen others quietly turn small, consistent investments into real portfolios, not by outsmarting the market, but by respecting it. The truth is, the market isn't your enemy or your friend. It's just a mirror that reflects your behavior. The real truth about wealth. Once you peel back all the myths, investing becomes much simpler, though not necessarily easier. The people who build real wealth aren't chasing hype stocks or trying to time the next breakout. They're doing boring things consistently over long periods of time. Take Jack Bogle, founder of Vanguard and creator of the index fund. He once said, "Don't look for the needle in the haystack, just buy the haystack." That's the opposite of what social media tells you, but it's the truth. If you had simply invested $100 a month in the S&P 500 since 2013, you'd have put in $14,400 total. By late 2025, that would be worth about $31,000 or more than double, without a single attempt at timing the market. No hype, no hot tips, no miracle trades, just time and patience. That's the part most people miss. They chase excitement instead of returns. They want investing to feel thrilling, but the best portfolios are usually the most boring ones. Breaking free from the myths. The biggest obstacle in investing isn't volatility, inflation, or the economy. It's belief. Most people lose money not because they pick bad stocks, but because they operate on bad assumptions. They believe they need more money to start. They believe they can find safe stocks. They believe they can time the market, beat Wall Street, or that the system is rigged against them. Those stories keep them trapped in fear or fantasy, both equally costly. The moment you stop chasing perfection and start embracing consistency, everything changes. You realize investing isn't a game of genius, it's a game of endurance. The people who win aren't the smartest. They're the ones who stay in long enough for compounding to work its quiet magic. You don't need secrets, formulas, or algorithms. You just need patience, the one skill the market never stops rewarding. That was all from us today for this video, folks. For more similar content, make sure to watch our last video on seasonal AI side hustles. See you in the next one.